I have covered high yield dividend ETFs in the past. These are more traditional in nature, paying right around a 5% dividend yield. They focus on owning underlying dividend stocks that pay high dividends, and then they share those dividends on to shareholders. However, in today's video, we're going to focus on 4 high yield ETFs. We're talking about huge yields. These ETFs are focused less on owning underlying positions and more about generating huge amounts of income. And how do they do this? They utilize options a lot more than they do focusing on underlying positions. High yields attract both income investors as well as retired investors alike. And when I say huge yields, I'm talking about 3 of these ETFs have distribution rates that are closing in or right around 60%. Yes, you heard that right, 60%. So make sure you watch the entirety of today's video as we go through each of these 4 ETFs. And before we begin, do me a huge favor. Click that like button down below. Subscribe to the channel as I truly appreciate it. It really helps the growth with the algorithm. And let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me do a quick shout out to today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. Right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. Check out the link down in the description below. All right, now let's get back to our video covering 4 high yield ETFs, and we're going to be talking about some huge yields today. But before we begin, let me cover some basics. When it comes to dividend yields, again, dividend yield has an inverse relationship to the underlying stock price. As stock prices go up, dividend yields come down and vice versa. Secondly, ETFs that utilize option strategies can see price erosion, their share price eroding over time as that strategy goes against them. Also, if you're utilizing a covered call strategy, you're also capping your gains out during that particular option. All right, now let's get into our very first high yield ETF. And as we progress through these, the yields are going to get that much higher each time. So let's begin with high yield ETF number 1, which is the JP Morgan Equity Premium Income ETF, stock ticker JEPI. JEPI is one of the most well-known high-yield ETFs, and really one of the ones that started a surge in new ETFs with similar strategies being filed here in just the past year alone. JEPI currently has assets under management, or AUM, of $30 billion, making it the largest of the 4 ETFs that we're looking at today. These types of funds are really nothing new, nor is the strategy behind them. But JEPI was just in the right place at the right time. In May of 2020, when the markets were in the depth of this pandemic that we just went through, a lot of investors were clamoring for high income, high yield to ride this out. JEPI came into action in May of 2020, and since that inception date, shares of JEPI have a total return of 46%. The strategy behind JEPI is a combination of owning low beta stocks as well as selling out of the money S&P 500 call options. So they take a 2-pronged approach. They actually own specific stocks, underlying positions, and they utilize an option strategy. So when JEPI is earning income, it earns dividends from those underlying positions that it already owns, and then it also sells covered calls. It takes that type of strategy, selling call options around the S&P 500. That's where the majority of this income that they're able to generate is generated from. Therefore, given that strategy, distributions are going to vary from month to month, and JEPI pays out a monthly distribution. Looking here at this distribution or dividend schedule, JEPI has paid $4.98 per share over the past 12 months, which currently equates to a distribution rate of 9.3%, which is a very high yield, but wait until you see the yields on the remaining 3 ETFs that we're going to look at. When it comes to selling covered calls and utilizing this strategy, you sell them with a strike price that's above and beyond today's price. But as the S&P 500 moves above that strike price, you are capping the gains that you could have. What this does is it causes erosion to the underlying share price. This is evidenced in the fact that JEPI shares are flat over the past 12 months, while the S&P 500 is up 17%. JEPI also has an expense fee of 0.35%, which could seem high, but it's actually going to be the lowest out of the 4 ETFs that we're going to look at today. High yield ETF number 2 is the Yield Max Tesla Option Income ETF, stock ticker TSLY. This next fund that we're looking at, Tesla, is an actively managed fund utilizing option writing, selling options in this case, all based around Tesla. Tesla currently has assets under management of $747 million and has really gained in popularity over the past year. Tesla was formed back in November 2022, so they are coming up on their 12-month, their 1-year anniversary. And since then, the share price has fallen nearly 40%. However, on a total return basis, Tesla has returned 1% to shareholders when you include the income that they pay out also. So how does Tesla work, you might ask? Well, what they do is they sell call options on the underlying stock Tesla, stock ticker TSLA, which is historically a very volatile stock. Right now, they have an option contract that expires in the next week or this coming week as of this video at a strike price of $225. Tesla right now trades at $220. If the stock price stays at or below $225, Tesla will collect and generate 100% of the premium that they already collected. However, if the Tesla stock goes above and beyond $225, this will be a losing strategy in this case for Tesla. So with this, there's a lot of risk that comes into this strategy. So here's a better look at the total positions within this ETF. As you can see, they have US Treasuries, and then they also have the option that they bought and the option that they sold to generate income. In terms of distribution, Tesla also pays out a monthly dividend, and it will vary depending on the success of the strategy in recent months. The fund currently yields a high distribution rate. Are you ready for this? 57% right now. Tesla operates with an expense ratio of 0.99%. High yield ETF number 3 is the Defiance S&P 500 Enhanced Options Income ETF, stock ticker JEPY. Now this ETF is brand new to the markets. It's only been out less than 2 months right now. And what they like to call it is the sexy JEPY. JEPY is actually the first put-right ETF on the S&P 500 using daily options expiring within 24 hours. So you can just imagine the risk right there. Options can add a completely new level of risk to your portfolio. And there are a number of ways to play options, but options expiring within 24 hours can generate a lot of yield for those writing the options, aka selling the option. So this is great when things work in your favor. So that first ETF that we looked at today, JEPY, JEPI, they own underlying positions and then they sell covered calls. In the case of JEPY here, JEPY, it also, just like the ETF we just looked at a second ago, does not have any underlying positions. All it does is sell one put option on the S&P 500 every single day. And that one put option expires within 24 hours. The entire strategy is solely focused on taking advantage of that time decay that happens that quickly and generating huge amounts of income, which is why they can pay a huge amount of distribution. Here's a look at the holdings of JEPY, JEPY, and you will find a 1-year treasury bond, a 1-month treasury bond, cash, and then the put option they wrote on Friday, November 3rd, which was a Friday, as I mentioned, and that expires on Monday, November 6th. So on Monday, November 6th, that option will expire, and they will write another option that expires the very next day. JEPY also pays a monthly dividend, and to date, they have only been around long enough to pay 2 monthly dividends. And if we were to annualize those payments, JEPY, JEPY, currently has a distribution rate of 59.2%. Since inception, JEPY shares have fallen 10% in 2 months, but on a total return basis, they have generated a 1% loss. So the entire goal here is solely focused on income. But you can imagine the risks that come along with zero DTE options. These fund managers have to be so precise with the options that they are selling day in and day out. The fourth high yield ETF that we're going to look at today is the Defiance NASDAQ 100 Enhanced Options Income ETF, stock ticker QQQY. So does that sound a little bit familiar? We just looked at JEPY. Now we're looking at QQQY. Defiance also pushed this one out just a few months ago. And instead of being focused on the S&P 500, QQQY is focused on QQQ. QQQY is the sister fund to Sexy JEPY. And really the strategy behind it is exactly the same, trying to generate huge amounts of income. The only caveat, the only difference between the two is the fact that JEPY focuses on the S&P 500, QQQY focuses on the QQQ index. QQQY went public in September of 2023. So again, a brand new ETF for you to keep an eye on for those of you searching for huge amounts of income through options. Here's a look at QQQY's holdings. The top holdings are very similar to JEPY. You're going to see different treasuries, you're going to see cash, and then our one option that we hold that expires the next trading day. Since inception, just a few months ago, QQQY shares have fallen 12%. But on a total return basis, they have generated a 1% loss, almost identical to that of JEPY. QQQY also pays a monthly distribution, which is generated entirely by option writing and the U.S. Treasuries. Based on a few distributions that have already been paid, when annualized, QQQY is generating an annualized distribution rate of 65.78% right now, the highest on our list today. QQQY also comes with an expense ratio of 0.99%, which seems to be the going rate for those last three ETFs that we looked at. However, those last three ETFs are generating huge amounts of income, with distribution rates hovering around 60%, and that last one upwards of 65%. But as we have seen, when it comes to these ETFs, it comes with a cost. Sure, the income is great, but when we're investors, we always focus on total return. Income is great, but at what cost? It's just the share price is eroding over time. Down 10%, down 30% in the share price, but when you add the income, we're sitting at even. With an S&P 500, that's up nearly 20% over that same exact period. So at what cost are you going to go lurking for this income? I don't own a position in any one of these four ETFs that I've talked about. And it's really due to the erosion that goes on and the risk. And another reason is the fact that I already utilize an option strategy on my own on a weekly and monthly basis to generate my own amount of income with a less risky approach. In the comments section down below, let me know which of these four ETFs would you ever be interested in investing in, or which of these four do you already invest in? I would love to hear those down in the comments section down below. And if you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.